Several of you have been asking in the comments the same question this week. Gold hit 5,405 in January. It is now at $4,564. The correction looks ugly. The headlines are full of uncertainty, and the loudest voices online are telling you the bull market is over. Today, we are going to answer that with data, not opinion, with documented, verifiable, institutional-grade evidence that tells you exactly what is driving this market and exactly where the structural forces point next. This is Go Finance. Let me start with exactly where gold stands right now, because precision matters. As of May 5th, 2026, gold is trading at approximately $4,518. It hit an all-time high of $5,405 per ounce in January 2026, the best start to a year for gold since 1980. Since that peak, it has corrected approximately 16%. The Iran war, which began February 28th, is the primary mechanism behind this correction, and understanding exactly why a war is pushing gold down instead of up is the most important thing you can understand about this market right now. Here is the mechanism. The Iran conflict sent oil above $100 per barrel. Brent crude surged nearly 8% on the initial strike. U.S. gas prices jumped 90 cents per gallon in just 19 days, one of the fastest retail fuel price spikes on record. That energy shock fed directly into inflation data. BLS March 2026 CPI came in at 3.3% year-over-year, the highest reading since May 2024, with a 0.9% monthly jump. When inflation reaccelerates, the Fed cannot cut rates. When the Fed cannot cut rates, the opportunity cost of holding non-yielding gold rises. Leveraged paper traders flush their positions, and the gold price falls. But here is the critical distinction that most people watching the chart are missing entirely. The paper price fell. The physical demand did not. The World Gold Council Q1 2026 data, the most recent institutional data available, shows total gold demand of 1,231 tons, up 2% year-over-year. Bar and coin demand of 474 tons was the second highest single quarter ever recorded. Central banks bought 244 tons in Q1 alone, up 3% year-over-year and 17% higher than the previous quarter. Poland and Uzbekistan led the buying as emerging market institutions accelerate reserve diversification. The total value of quarterly gold demand hit a record $193 billion, 74% higher than the same quarter 1 year ago. Read that again. During the worst correction gold has seen in this cycle, while the paper price was falling, while the headlines were screaming that the trade was over, the physical market set an all-time record for demand value. That is not a dead market. That is a market with a paper price that has temporarily disconnected from the physical reality underneath it. That gap always closes. It never closes in the direction of the physical market coming down. Now let me walk you through the four forces that are simultaneously holding the structural floor under gold and will eventually push it back through $5,000 and toward the $6,000 targets that Bank of America, Deutsche Bank, Wells Fargo, BNP Paribas, and Societe Generale are all projecting for year-end 2026. Force 1. Central banks are buying gold at a pace that has no historical precedent, and they are not slowing down. Before 2022, central banks bought approximately 200 tons of gold per year globally. That was the decades-long baseline. From 2022 through 2025, central bank purchases averaged approximately 1,000 tons per year, 5 times the historical average. In Q1 2026 alone, they bought 244 tons. Analysts expect central bank purchases to total between 700 and 850 tons for all of 2026. The People's Bank of China reached an all-time high of 2,309 tons of official gold reserves in Q1 2026. Goldman Sachs estimates central banks are averaging 60 tons of gold purchases per month. Why? Because when the United States froze $300 billion in Russian central bank assets in February 2022, every government watching concluded the same thing. Dollar-denominated assets can be seized by executive order with no judicial review and no recourse. Gold in a domestic vault cannot. That is not a temporary reaction to a temporary crisis. That is a permanent structural reassessment of what a safe reserve asset means in the current geopolitical environment. And that reassessment is compounding with every month that the Iran war, the Middle East instability, and the weaponization of the dollar continue. JP Morgan models that every 100 tons of central bank buying corresponds to approximately a 1.7% increase in the gold price. At 800 tons projected for 2026, that structural floor alone, independent of ETF flows, independent of retail buying, independent of everything else, supports prices well above current levels. Plus, two, the US fiscal picture has deteriorated to the point that every major credit agency has now downgraded American sovereign debt. In May 2025, Moody's downgraded the United States from AA to AA1, making it the third major rating agency to do so after Standard & Poor's in 2011 and Fitch in 2023. The numbers behind that downgrade are extraordinary. The US federal deficit is running at 6 to 7% of GDP at full employment. Federal interest expense is approaching $1 trillion annually, now larger than the defense budget, larger than Medicare, larger than Social Security. Moody's projects the national debt will reach 134% of GDP by 2035, and that interest payments will consume 30% of all government revenues by that date. The US has never exceeded 120% debt to GDP, even during World War II. From 1971, when the US abandoned gold convertibility, through 2025, gold rose from $35 per ounce to over $5,000, while the dollar lost approximately 87% of its purchasing power, according to Bureau of Labor Statistics data. The dollar did not stay stable while gold went up. Gold stayed stable while the dollar went down. The fiscal trajectory that Moody's just formally documented is not improving. It is accelerating, and that acceleration is structural fuel for gold that does not switch off when the Iran war ends. Force 3. The Federal Reserve is caught in a policy trap that gold has historically exploited to the upside. As of May 5, 2026, the CME FedWatch tool shows a 94.9% probability that the Fed holds rates unchanged at the June meeting. Just 5.1% probability of a cut. Goldman Sachs, which had previously projected 3 cuts in 2026, has pushed its first cut forecast back to September. The Fed cannot cut because inflation is too high. It cannot raise rates significantly because the debt service cost on $39 trillion in national debt at higher rates would be crushing. Every 25 basis point increase in rates adds approximately $100 billion in annual interest expense to a government already paying $1 trillion per year. It cannot stay on hold indefinitely without eroding credibility. Every option carries a painful trade-off. That is the definition of trapped. Now here is the critical mechanism most people miss. Goldman Sachs has documented that each 25 basis point Fed rate cut generates approximately 60 tons of new ETF gold demand within 6 months. Global gold ETF assets under management doubled to $559 billion in 2025. Physical ETF holdings reached a historic peak of 4,025 tons. Those ETF holders are positioned and waiting. When the Fed eventually moves, and the weakening growth data is already forcing that conversation, a wave of institutional demand will arrive on top of the central bank structural floor. The 2019 precedent shows what happens. When the Fed cut in July 2019 for the first time in over a decade, gold rallied approximately 7% in 6 weeks. The 2026 structural backdrop, central banks buying at 5 times historical pace and $559 billion in ETF capital positioned for re-entry, suggests the response this cycle will be significantly larger. Force 4. The Iran war has created stagflationary conditions that historically produce the most powerful gold environments that exist. Low growth and high inflation simultaneously. Oxford Economics cut its 2026 US growth forecast from 2.5% to 1.9% specifically because of the war's effect on consumer spending. American households have spent nearly $4.5 billion more on gasoline since February 28th compared to pre-war levels. Money that is not going to restaurants, not going to clothing stores, not going to savings, but directly to energy costs. At the same time, inflation is running above the Fed's target, and the energy supply disruption from the Strait of Hormuz is keeping that inflationary pressure alive. Goldman Sachs acknowledged this directly in its most recent note, stating that gold remains vulnerable to further liquidation in the near term should Hormuz disruptions persist and bond or equity markets correct further. But Goldman simultaneously maintained its $5,400 year-end target. That is the tension at the heart of this market right now. Short-term, the war is a headwind through the rate mechanism. Structurally, the war is creating the exact conditions: stagflation, fiscal deterioration, geopolitical fragmentation, de-dollarization that have driven every major gold bull market in history. Now let me address the institutional consensus, because the scale of professional agreement here is something that does not happen very often. Bank of America stands firm on a 12-month $6,000 gold target, confirmed as recently as May 1st, 2026. Deutsche Bank projects $6,000 by year-end. BNP Paribas projects $6,000. Societe Generale projects $6,000, calling it potentially conservative. Wells Fargo raised its year-end target to $6,100 to $6,300 and explicitly advised clients to buy the current dip. Goldman Sachs maintains $5,400. JP Morgan projects $5,055 by Q4 2026, rising to $5,400 by end of 2027. UBS targets $5,900 by late 2026. Morgan Stanley has a bull case of $5,700. Not one major investment bank has a year-end 2026 gold price target below current levels. The debate is not whether gold goes higher. The debate is only about how much higher. And the base case for every major institution on that list requires the same sequence: a diplomatic resolution to the Iran conflict, oil prices normalizing, CPI moderating, and the Fed resuming rate cuts. None of those things requires extraordinary optimism. They are the base case. The bull case requires only that things stay uncertain, which the current data strongly suggests they will. What does this mean for stackers right now? The correction from $5,405 to $4,518 is a 16% pullback in a bull market that ran from approximately $1,800 to $5,405, a 200% move over 3 years. A 16% correction in a 200% bull market is noise for anyone with a time horizon longer than 6 months. The structural forces have not changed. They have in several cases gotten stronger. The Q1 2026 data is unambiguous. Bar and coin demand of 474 tons was the second highest quarter ever. $193 billion in total quarterly demand value was a new record. Central bank purchases of 244 tons were up 17% from the previous quarter. Asian investors, the buyers with the longest time horizons and the deepest conviction in the physical market, were described by the World Gold Council as, quote, hoovering up gold investment products. Serious money is not selling. Serious money is accumulating. The paper market is responding to the short-term rate signal. The physical market is responding to the structural reality. And in every previous cycle, those two markets have eventually converged. The physical market wins. The 5 catalysts that will push gold back through $5,000 are all already in place. A Fed rate cut that generates 60 tons of new ETF demand per 25 basis points. A ceasefire or oil normalization that removes the stagflation headwind. Continued central bank buying at 60 tons per month, providing a structural floor. ongoing US fiscal deterioration that makes gold's role as a debasement hedge more obvious to more investors, and de-dollarization that is now structurally embedded in sovereign reserve management policy across the emerging market world. We are stackers here. We understand the difference between short-term price signals and long-term structural forces. We understand that the most dangerous thing you can do in a real bull market is let a temporary correction shake you out of a position that the data says is fundamentally correct. The correction did not change the thesis. It gave you a better price to continue executing on it. Drop a comment below. Where are you watching from, and what is your gold price target for end of 2026? I read every comment, and I will pin the best analysis. If you want this analysis in your inbox every morning before markets open, join the Go Finance newsletter. Every day before the session starts, you get a direct summary of what is moving gold and silver, what the data says, and what to watch. No noise, no headlines, just the information that matters before anyone else has it. Link is in the description and in the first comment below. Subscribe. Turn on notifications. Data before price. The Vault Keeper.